Eric, thank you very much for joining us today. How are things in New York?
They're good, James. Thanks for inviting me on. It's good to talk to you.
My pleasure. I'm looking forward to this conversation. You and your team have done a lot of research on the U.S. housing market, and since this is the largest purchase most people will make in their lifetimes, I want to spend some time talking about the U.S. housing market and also the health of the consumer. But before we do that, I first want to get a sense of your thoughts on the U.S. economy. We recently saw a very strong Q2 GDP print. It came in at 2.8%, much stronger than what was expected, and also much higher than the previous quarter, which was 1.6%. But what's your take on the Q2 number? Was it a real number? Do you think the economy is heating up again, or was it just fake?
So, when the GDP numbers come out, everyone has to remember that there are many elements to these GDP reports. Some of them are very erratic, or what we would call the irregular element of GDP. These are things like big swings in inventory, big swings in net exports, changes in government spending. Those things can have a addition effect in some quarters and a subtraction effect in other quarters, which is to some extent what we saw in Q1 and Q2. Q1 was pushed down by some of these factors, and Q2 was pulled up by some of these factors. So whenever the GDP report comes out, what we do and what we publish in our analysis is we strip out all of those irregular or volatile elements, and we look at the trending elements, the consumption and the business private investment most specifically. And on that basis, the economy is decelerating, but it's been decelerating very, very, very slowly, much slower than we all would have expected, particularly given the magnitude of the tightening cycle that transpired over the last year. And then to get a leading element on what's going on with the economy, we can look at the very narrow parts of the GDP report that are more cyclical, more interest rate sensitive. So we really want to focus on the very, very small slivers of the economy, like durable goods consumption, rather than total consumption, because total consumption may include things like healthcare services, food, clothing, things that you have to buy, whether the economy is in a recession or a booming expansion. The narrow sliver of durable goods consumption, things like washing machines and cars and bigger ticket items, those are more discretionary that you'll only typically buy in large quantities during big booms, and you'll pull back pretty aggressively. So we want to be looking at the durable goods consumption. And then within the business investment, we want to look at the housing investment, which I'm sure we'll talk about, and then what we call business equipment investment. So the investment in the production of a lot of these durable goods items. And when we look at those categories, again, we see that slowing element coming into the economy, that decelerating element, but we're not seeing yet a dramatic contraction. And whenever the economy goes into a recession, it's those very small three categories that are going to drive almost 100% of the decline that you're going to see. You're almost never going to see contractions in services, consumption, the things that honestly most people, when you go and listen to financial media, they'll say the economy is a services economy. And this is true by the numbers, but that part of the economy doesn't really have booms and busts. It's extremely stable, and it often doesn't even contract in recessions. So when the GDP report comes out, we want to kind of strip out all that volatile stuff, and we want to look at the trending component and then the leading components. And when we do that, we still see this overall trend of deceleration, but we're not yet seeing a full contraction yet, although that does look like it's developing, particularly after some of the weaker labor reports that we've gotten in recent months.
So if you take the 2.8% and you strip out all the noise, what's the real number? This interview is sponsored by Aura. In addition to being very concerned about the economy and how it's going to impact my financial future, I'm also concerned with identity theft. Did you know that AT&T recently announced that it had a data breach of 73 million customers? Ticketmaster, a website I use all the time, was hacked, exposing over 500 million customers, including their emails, phone numbers, addresses, and financial data. In 2022, Americans lost over $10 billion to online crime. So how do we protect ourselves in this digital world that we all live in? Aura provides identity theft and fraud protection for your finances, your personal identity, and also your family. To learn more about Aura and how it can protect you, simply click on the link below, aura.com/Bloor Street Capital to start your free 14-day trial. The 14-day trial includes identity protection, transaction monitoring, scam call protection, antivirus, and so many more benefits that will protect you and your family. Once again, aura.com/Bloor Street Capital to start your free 14-day trial. Now back to the interview.
So we're growing at about 1.5% when you strip out all the noise, and I'll give it in nominal numbers too, just to make it a little bit easier for everybody. In nominal terms, so growth plus inflation, the nominal economy has been growing about 5 to 6% in the GDP reports. That's about 3% from those cyclical elements. So if those cyclical elements are growing at 3 and the whole thing is growing at 5 or 6, that means those non-cyclical elements, the parts that we kind of ignore, that's what's growing at 6, 7, 8% in nominal terms. So we have a more pronounced weakness in the categories that really matter. It's being bolstered by the categories that don't matter as much. And we have to kind of maintain a focus on those cyclical categories. I always, whenever I talk to clients, I always say that it's not the strength of the non-cyclical categories that we should be focused on. It's the weakness or lack of weakness in the cyclical category. So if the non-cyclical stuff is growing at 4, 5, 6%, the economy can very much still be in a recession if those cyclical elements are contracting. Those cyclical elements are not yet contracting in aggregate, which is why the economy has been able to stay afloat through this point.
And when you look 2 or 3 quarters, when do you see the economy going negative?
That's always difficult to say with any type of precision. The process that I use is a leading indicator process. And a leading indicator process is far more accurate directionally than it is predicting magnitudes. So it's really difficult to say that 4 quarters from now, we're going to have growth of -1. I don't try and proclaim that I can do that. And I don't believe that there are any techniques out there that can really do that with any precision. But what a leading indicator process can do with a high degree of confidence is give you direction. So these broad leading indicators are still pointed downward. Those leading indicators are contracting. And what I mean by leading indicators in the most granular sense is really trying to track the availability of money and credit. If money and credit is tightening, it's very difficult for those cyclical interest rate sensitive sectors that we just talked about to expand. And if money and credit is very loose and plentiful, then those cyclical or interest rate sensitives will have a big boom. So these leading indicators, the availability of money and credit is broadly still contracting, as the Federal Reserve has not engaged in a major easing cycle yet, although that may be coming. So money and credit is still tight. Those leading indicators are still contracting. That's putting downward momentum through the whole business cycle. So we can have confidence for now that the direction of travel is still to the downside, although I wouldn't try and profess that I could nail a number with any precision. So I would say by the end of the year, broad measures of the economy, like the unemployment rate, to use one example, will probably show weaker readings than we're seeing now.
And so there's this ongoing debate on whether or not the U.S. is in a recession. If I'm hearing you correctly, you don't think it is at this point.
As it stands now, with the data that's available, we would say no. However, I have to caveat that the direction of travel has been downwards, And economic revisions tend to come in the direction of the economic momentum. So I'm sure you're well aware, as your viewers are, that I think we've had 11 out of the last 13 job reports be revised downwards. I could have that slightly wrong, but it's in that ballpark where it's been a high number of these reports have been downwards. Now, some people will say that this is political. It's not political. It's the nature of the way these numbers are modeled and produced, that errors always occur in the direction of economic momentum. So as the data is reported today, as we're recording this in early August, we don't have sufficient evidence to say that the economy is in a recession. However, it's likely that the data that we're looking at right now will be revised lower in the future. The magnitude of how much that revision is an open question. So you can't quite rule it out. But I would say that it's unlikely given the data that we're able to see right now.
Only with the government can you make that many mistakes and still keep your job.
Yeah, that's right.
So you touched on unemployment. Let's go there. And the most recent number came in at 4.3%, which was much higher than the previous month. That was 4.1%. What's your take on the unemployment rate? And is this going to continue to go higher?
Sure. So we use the same process for tracking employment cycles as we do business cycles, where we're looking at what we would call coincident measures of employment, which would be the stuff that we look at and report on every month: the number of payrolls, the unemployment rate, wages and income from employment. Those are what we would call coincident employment indicators. They don't give you any reading on what's coming, but they define where we are right now. And when we just look at those coincident variables, to use the unemployment rate, as an example, there's a clear trend in place that the unemployment rate has been rising very steadily for over a year now. So the big jump that we had certainly didn't come out of nowhere. This has been a trend that's been in place for a while. Now, the question is whether that trend is noise, is it a normalization, or is it a more ominous business cycle trend? To answer that question, we use, again, leading indicators of employment. And again, leading indicators are not a voodoo type of concept. What we're trying to do is we're trying to gather information about the steps businesses will take before they lay off employees, because laying off employees is a very difficult decision. It's very costly for businesses. There often is a lot of emotion involved with managers laying people off. So businesses will often wait to the last possible moment before they engage in large-scale layoffs, and they'll take a lot of steps beforehand to try and protect profits and margins as they see businesses slowing. So things that they'll do are they'll reduce their capital expenditures, or CapEx. They will cut the hours worked of their employees before actually laying them off. They'll reduce temporary help labor, as an example. And we can go down the list of gathering a basket of 6 or 7 different things that businesses will do before they'll make the very costly and binding decision of laying people off. And when we put all of those indicators together, we have a basket of what we would call leading employment indicators. Again, those leading employment indicators have been contracting really since the end of 2022, certainly throughout 2023. So that gave us warning that we should expect the unemployment rate to start creeping up. Now, when you hear me say 2022, that sounds like a long time ago, but I'll remind the audience that the unemployment rate bottomed in January of 2023. So if you're going to lead that bottom, those leading indicators had to signal that bottom before that occurred. So the leading indicators started to contract, or signaling worsening employment conditions towards the end of 2022. As you got into 2023, you saw the very beginnings of a rise in the unemployment rate. Those leading indicators remained in contraction and are still contracting today. So whenever you see a trend develop, specifically a trend in the unemployment rate, and that trend came after it was signaled by a broader basket of leading employment indicators, that is a real business cycle signal. It's not noise. It's not a normalization. So I expect the unemployment rate to continue trending in the direction that it's been going, and that's overall a negative business cycle signal. And given that we've increased about 90 basis points on the unemployment rate, historically, that magnitude is a level that's, more or less consistent with the beginnings of a recession. So we do have to keep an eye on it that towards the end of the year, if we're at 4.4, 4.5, 4.6, we're going to be talking about more than a 100 basis point increase. It would be extremely unlikely for the economy not to be in a recession should that trend continue in the unemployment rate.
And have you and your team computed another unemployment number that differs from what the government is putting out?
Well, we can measure employment in a lot of different ways, and the government also measures employment in a lot of ways. The one that we all follow is called the U3 unemployment rate, but they have measures from U1 to U6, getting increasingly broad as you go from 1 to 6. So the U6 unemployment rate is not 4.3. That actually increased 40 basis points in the last report from 7.4 to 7.8. So when you take a broader measure, you could say that the unemployment rate is closer to 8%. It all depends on how you want to measure it. In my view, they're all valid measures, as they are defined. You can use any one you want, but it's never useful to throw out a number. It's only useful to throw out the number in the context of a trend. So if I said to you, James, my team calculated that the unemployment rate is really 10, but that's going from 12 to 10, that's an improvement in employment conditions. If you take an unemployment rate that is like the U3, and I said, no, it's really 4, but it went from 3 to 4, that's directionally worse. So I think that the government provides a lot of different measures. We can also create our own from a variety of baskets. I don't think the level is that important. Across any basket you want to put together or any unemployment rate you want to calculate, the trend is of a loosening labor market or worsening employment conditions. And I think that that's the broader point here.
Eric, let's discuss the residential real estate market now. When you look at the economy as measured by the GDP, the rising unemployment rate, the consumer is definitely under pressure. What's your take on the residential real estate market? Any concerns when you look at the country as a whole, or are there pockets of concern within the U.S.?
Sure. So we spend a lot of time on residential real estate because it's so important to the overall business cycle. Now, again, I repeat a lot of the same themes where you'll hear people say the consumer is 70% of the economy, or the corollary to that would be housing is, as measured directly, only about 5 or 6% of GDP. Therefore, it doesn't matter because it's, only 5 or 6%. But the volatility or the amplitudes of that residential cycle are so large that it has a multiplier effect, or it has an effect on aggregate GDP way larger than the 4, 5, 6% that it seems when it's measured directly. So the residential cycle, again, is much more nuanced than you hear on TV, because when we're talking about residential housing, it moves in a cycle the same way that the overall business cycle does. So we have to differentiate whether we're talking about the early part of that cycle, which is housing volumes, how many homes are being sold, the transaction level, construction and employment of construction workers, which is sort of the middle part of that cycle, or home prices, which is really the end or lagging part of that cycle. So when people will say the economy is doing well because home prices are holding up, that's a very misleading statement, because that's looking at a lagging indicator to explain what's either happening now or what's going to happen in the future. So as we snake through that cycle, housing volumes are very, very, very depressed. And they've been depressed for the better part of the last 2 years as the Fed raised interest rates that put immediate downward pressure on the volume of transactions. When the volume of transactions slows, eventually that leads to the construction cycle slowing, because if home builders are selling less homes, they need to build less homes. There's been a large lag this cycle between that volume and construction, particularly because there's a lot of backlogs that built up in after COVID. But we're starting now to see that residential construction cycle really rolling over, with building permits falling, construction spending falling, and the month supply in the new home market is starting to creep up. But because we haven't seen that middle part of the cycle, the residential construction and residential employment, because that part hasn't fully rolled over and is not contracting in a really big way, we really shouldn't expect home prices to have come down yet. Now, again, this whole sequence has taken longer than it has in past cycles, but the sequence, always remains the same. We're still being held up in that middle part. But again, we're starting to see signs that construction cycle is rolling over, as well as the employment in those categories. Once that happens, then home prices are at a larger risk of coming down. So that's the overall sequence. And it really depends what part of the sequence you're talking about when you analyze the housing market. To speak more specifically about prices, because that is what a lot of people are concerned about, the best metric to use, in my opinion, to get a sense of home prices and where they'll be trending is the month's supply, is what it's called. And that measure takes into account both supply and demand. It takes into account the level of inventory as well as the pace of sales. And when we look at the entire U.S. housing market, the month supply is about 4.5. A balanced market is about 5.5. So when the month supply is lower than 5.5, that generally means that inventory is tight and there will be upward pressure on prices. And when the month supply is above 5.5, that generally means that inventory is loose and prices will come down. So given that we're at 4.5 right now, if you had to make one broad characterization about the U.S. housing market in terms of prices, you could still say that inventory is tight and prices will remain stable to upwards. But as we all know, real estate is very regional. So if the entire country is at 4.5, that means there are some markets that are at 6 or 6.5, and there are some markets that are down at 3 or 3.5. They all come together to make 4.5. But if you're in a market that has a month supply of 5.5 or 6, which generally speaking is parts of Florida, Texas, Phoenix, Vegas, those markets are seeing legitimate downward pressure in prices now, but it's being fully offset at the moment by the markets that have very tight supply, like the Northeast and parts of the West Coast in California, where month supply is still down at 3. So again, to take the whole cycle, we have housing volumes very depressed. The construction cycle is starting its process of rolling over. Home prices are still stable as a result of that, but you're seeing pockets of weakness as that month supply is creeping up. And that's overall where we stand. And that direction, again, is going to continue. So I would expect that weakness to sort of broaden out. But when we're looking at a national home price statistic as one metric, we're still probably a little bit away from a broad decline.
So in spite of a slowing economy and higher unemployment, still no concern when you look at the country as a whole.
Well, I have concern in terms of the direction of travel in terms of prices, specifically if you're in one of those markets that has an elevated month supply, because again, the direction of all of these trends is going to continue. So if you're in a market that's already at 5.5 or 6, that means several quarters from now, you may be at 6.5, 7, or 7.5, which is starting to get into the area where it's very loose and you're going to get some really big declines in prices. But again, it's very regional, so you have to take that with a grain of salt. So I am concerned about pockets of the country in terms of price declines now or in the immediate future. But if I was to bet on the, Case-Shiller National Home Price Index, that's probably not going to show an outright decline in the next couple of months, given the whole picture. But price growth will slow because inventory broadly is going to keep going up. So I wouldn't say that I'm not concerned. It really depends on where you are. But for everybody, the national trends are of slowing conditions. But if you're in a market that's at a 3 or a 3.5 month supply and the trends get worse to 4, 4.5, you still have some room before you're going to have like big drops.
Hey, put that number into perspective for us. How does it compare to what you saw back in 08, 09?
08, 09 was at 10 to 12 month supply. So month supply was, we've never seen 10 or 12 in the aggregate housing market. Like I said, balanced is about 5.5. In 08, it got to periods of time where it got to in between 10 and 12. If you get to 6 or 6.5 or 7, you're definitely getting price declines. So when we got to 10, 11, 12, that's when you're kind of in the no bid territory. I wouldn't expect, and most of the people that I speak to in the economics of housing would never expect us to get back to that level. It would be pretty unusual, I would say, for us to get back to that level. It was, somewhat of an anomaly driven by really loose underwriting standards, and you had a credit bust, and there was a lot of factors that contributed to getting the inventory levels that high. You also had a really brutal job loss recession. It was about 8 million job losses. So I would say both on the inventory side and on the job side, it's probably not a good bet to make your baseline 08, just given how dramatic it was in all areas. But if the national market gets to, 5.5 or so, that's pretty loose, because I'll, remind your viewers that we haven't been at a 5.5 in the national U.S. housing market since, I think, 2012. So we're going on 12 years where we haven't been at balanced. We've been below balanced for basically 12 years and counting, which is why prices have kind of continued to trend up. So for the U.S. housing market, just getting back to 5.5 would be something we haven't experienced in a long time, let alone if we got past that.
So that's a good overview of what's happening on the residential side. I want to pick your brain now about the commercial side. And there's a company called Castle Systems, and they manufacture card swipes. So every time you go in and out of an office building or your office, you have to swipe in. They keep track of all the information. They know who's coming and going. They have 2,600, or they're contracted with 2,600 buildings, 41,000 different businesses in 138 cities throughout the U.S. And the number, they produce a number every month. You can see who's coming and going within their buildings. But when you look at the system-wide, it's 51%. So 51% of the tenants are going into their buildings. That means 49% are going to the office. And you got to wonder what this whole remote or work from home thing is going to do to the commercial real estate market. But Moody's just came out recently with a vacancy number. They said the nationwide number is 20.1%. That's what it was in Q2, and that's the highest number since 1979. What's your take on the commercial real estate market? Do you have concerns there?
Yeah, so commercial real estate is obviously an extremely broad bucket with multifamily apartments, office buildings, shopping centers, hospitals, malls, you name it. It's an absolute enormous category that spans many different sectors, all with entirely different characteristics. When we're talking about the office market, that's what we would call a really long duration commercial real estate asset, because the leases tend to be many years, 5, 10, 15-year leases. So when you talk about a slow moving train wreck, it couldn't possibly be any slower than it would be in office, because if you have a 10-year lease, you could try your hardest to get out of it, and maybe you can sublet it for, a lower price than what you're paying for it. And, but it's tough to get out of a lease entirely. You're not going to renew it when it's up, but if your lease doesn't expire for 5 years, even if no one's coming, you kind of have to eat it for 5 years. So even if the place is empty, you still might be paying for it. So it's a very, very, very slow moving issue in the office sector. There's also a little bit of a bifurcation in the sense that if you have a brand new constructed office building that was completed in the last year or so, or is about to be completed, it's going to be state of the art. It's going to have all of the best amenities. It's going to be a place that employees probably wouldn't mind coming because it has so many features to it. Those office buildings in the major cities are being leased up at premium rates. You think like in New York City, close to where I live, the premium office buildings right next to Grand Central are really having no problems at all. It's when you get into what's called the Class B or Class C office buildings, which is all of the people are leaving those buildings to go into the newer ones, and then there's no one coming into those B and C office buildings. Those are experiencing a lot of issues. They're going to continue to experience a lot of issues, but it's going to be a very, very slow, drawn-out process. I also think that in the marketplace, a lot of that, quote-unquote, destruction has been accounted for. Where I think more problems could come in the broader commercial real estate space is in the multifamily apartment sector. And the reason for that is because there's not a lot of discounting for a lot of trouble in that sector. It's a sector that's been very, very, very heavily built in the U.S. and I think also maybe in Canada over the past really 10 years or so. So there's been a lot of building of multifamily apartments. Some of those buildings in the areas where they've been very overbuilt are having trouble leasing up their buildings at rates that are commensurate with their projections. And also the cap rate or the interest rate has changed so much from when they built and projected these buildings. So there's a lot of pain potentially in the multifamily sector. And part of the reason that that's an interesting one to watch is because that's been perceived as sort of a bulletproof AAA asset. And in some cases, we're starting to see pockets of distress in that area. And that's one that has not been accounted for in some of the private equity and regional bank space that holds the debt on a lot of these assets. Again, there are some multifamily assets that are, tier one assets that are, obviously have no problems at all. But I'm more interested in what happens to the multifamily sector if we do get a full job loss recession, which certainly still looks on the table given the leading indicators that we talked about. And should that unemployment rate continue to rise, those rents are going to have trouble maintaining the level that they were projected at. So you're going to get a compression or a drop in rents. We're seeing increases in expenses on these buildings from things like insurance, which is causing those net interest incomes to fall. So I'm really interested in what happens in the the multifamily sector. I think that'll be bigger in terms of a potential dynamic playing out in commercial than office.
So, yeah, thank you for clarifying what's happening with these office towers, because I read an interesting story recently about a building in Manhattan that sold for $8.5 million, which was 97% below the last selling price. It was number 135 West 50th Street. It's a 23-story office tower, and I guess it must fall in this category of being a Class C, and that's why it went so cheap. But I'm reading more and more of these stories about these office buildings in various cities that are like, they can't give them away.
Yeah, you hear some really dramatic headlines, and it makes you wonder who's taking these losses, right? And we just have to see how it plays out. It's like I said, it's a very slow moving issue. It's a very slow moving sector, and it's also a very pro to pro market. So that means there's a lot of backdoor, lawyers and extend and pretend and restructuring and a lot of these things that happen in the more quote unquote professional market versus the 2008 cycle, which was a residential consumer facing issue. Not suggesting that the commercial issue is going to, repeat anything that was like 2008, just trying to draw the distinction between what's considered sort of a pro to pro market versus a consumer facing market. So it has the tendency to play out slower for sure.
So you touched on Canada. I want to throw an interesting stat before we wrap it up here, but in the city of Toronto, we have more cranes, construction cranes than any other city in North America. In Q2, there was 221 construction cranes throughout the Greater Toronto area. That compares to the second highest city, which is LA. They had 50. So that gives you some idea of the construction of buildings going on in Toronto, most of which are condos, by the way. Okay. And sales of condos in the past year are down 57%. You can't give them away right now.
Yeah, that's pretty dramatic. Let me ask you a question, James. If you have the numbers on hand, is that 221 figure trending up or is it trending down?
It is down. I believe it peaked in 2022 at around 250.
Okay, so it's certainly trending down, not down dramatically. I mean, that's still quite a lot of activity.
Well, and as you know, like these, from when you start building until people move in, you might be looking at 5 years or more, right? So
That's right.
There's a lot of projects that are still in the works. And I think I read there's another 500 which are scheduled to come online between now and 2027. So
yeah, that's dramatic. One comment that I would make that I find of particular interest as a longer term trend. It's happening in the United States. It's happening in Canada. It's really happening in more and more economies around the world, is that as these economies become increasingly indebted, as we are in the U.S., both public and private sector, as Canada is, and as China is, it's really difficult to spur genuine private sector demand for new investment. And that causes the economy to slow and slow and slow. So to offset some of that slowing, there's a lot of government-generated credit demand for housing. And it's a way of sort of trying to stimulate the economy. So we see the poster child for this is China, where there's tons of centrally directed credit towards building these apartments that nobody lives in. In the US, as I mentioned, we've spent the last 10 or 15 years really levering up towards building multifamily apartment buildings. Very similar story in Canada as well. And what that does is it pushes the economy into somewhat of a corner. China being, again, the poster child for this, where if you stop building the apartment buildings, your unemployment rate's going to go up because that's what's been sort of artificially supporting the economy. But at the same time, if you keep building these apartment buildings that already no one is living in, it's very difficult to keep the prices of these assets really high. So China sort of hit the wall on this issue where they are continuing to build some of these buildings, but the prices are crashing very dramatically, and that's leading to a big wipeout in wealth, and it's causing a lot of issues for their economy. They're actually experiencing deflation because of it. In the U.S., we're not obviously at that stage. I'm not sure if Canada is either. I don't focus on Canada as specifically, but from a broader point, more and more economies around the world are sort of levering themselves up to single family and multifamily housing. It's not a sustainable model. It can go on for a long time, but it's ultimately not sustainable.
Very interesting points. And I want to thank you very much for spending time with us today, Eric, and sharing your thoughts on the U.S. economy and also the real estate market. And if somebody would like to follow you online or learn more about your services, where can they go?
Yeah, thanks, James. I'd love to do it anytime. I publish some work on YouTube. I publish a lot of videos with, interesting graphics and animation. So if you search EPB Research on YouTube, you'll see a lot of free content of business cycle analysis and U.S. real estate. So I would certainly check out some of those videos. And if you go to epbresearch.com, that's where you'll find all of the institutional services that we offer to our clients in terms of business cycles. So I would check out YouTube for some freely available content, and then epbresearch.com if you'd like to learn more about what it is that we do and how we can maybe help your business.
Once again, thank you.
Thanks, James.